Hi, welcome. Thank you all for coming. I'm Toni, the president of the Australian Women in New York. So, any Australian women out there or Kiwi women joined us, come along. There's lots of events. We're happy to be our partner tonight with Josh, America Josh, and the Odin and
Milk chocolate.
Not
chocolate milk.
Sorry, everyone. Team. I just want to do a huge shout out to the AAA for allowing us in this space. It's, as you see, it's amazing, great news of the city. Big thanks to, of course, Josh, Odin. Kind of getting in tonight. And of course the Warning Events team and partnership and leadership team for helping organise this. So I'm going to stop now because I'm messing up this really bad and hand it over to Josh. Thank you.
Awesome. Thank you, Toni. Everyone give Orny and Toni a round of applause. They've done a fantastic job tonight helping us all out. I want to extend my thanks to everyone as well for coming along tonight. I know, coming to a physical event is not always the easiest thing after a big day at work, so we really appreciate you coming out. We've got some fantastic information. We try to put together these seminars and webinars and information packages for you because we know a lot of these topics are at the front of your mind. We want to make sure you've got good advice. If you walk away from today just having some great things under your belt and you feel good about what you've learned, that's fantastic. These three professionals, experts, are able to be contacted after the event, and after this panel, there's also a bit of a chance to ask some questions. So we will do a quick Q&A after they do their presentations, but there's also a chance to connect with them one-on-one post this event and after the panel. So I want to introduce Stephen Lee, Pau Lam, and Richie Ragle. Give them a round of applause as well. Stephen and Pau come from Odin Mortgage and Tax, and Richie Ragle is from Milk Chocolate. And they're going to each do a presentation that talks about their particular point of expertise. So Stephen's going to focus on the mortgage side of information, Pau's going to focus on the tax perspectives, and then Richie's going to focus on the property perspective. So we've got all sorts of information that's going to be coming at you, and I'm going to do the introductions as we go through so that it's at the forefront of your mind. So Stephen Lee, give us a wave. That's very proud. So Stephen is the expat mortgage specialist at Odin Mortgage and Tax. He's got over a decade of experience in this space. And I think we've done a few webinars together, Stephen, before, and it's always great to find a professional that can sort of talk off the cuff and answer questions as we go. So I'm going to leave Stephen to do most of his presentation for himself, but there might be a few chances for me to ask him questions so that I can get personal advice. But the first thing I do want to let you know before we get started is that we are filming all of this. So if you do want to recap anything, we're filming and recording all of this. There are photos. John is going around taking photos and some film of all of you. If any of you are not comfortable with being featured in social media or any of our materials after, just let me or any of these guys or John in the blue know, and we can make sure that you're kept off them as well. But without further ado, Stephen Lee, with more than a decade in Australia's banking and mortgage sector, Stephen, you now specialise in helping expats specifically. So was that born out of personal experience that you wanted to know this kind of stuff and you wanted to help people, or how did you come to be here tonight? And then you can launch right into your presentation.
Yeah, absolutely. So, well, firstly, just wanted to extend my thanks to everyone taking out your time to meet with us. And yeah, Josh, to answer your question, so I'm actually a newbie expat myself. So I was growing up in Sydney, flew into Singapore a couple of years ago to set up the office for Odin. So have been going through the expat life and enjoying different culture myself. But on the property side, so for my own property in Australia, when I was trying to do something, it was just completely different to what I had to go through in Australia. So I learned it in a hard way, but all the lessons, it's a pleasure for me to just pass it on to our clients to make sure that we help you not make costly mistakes.
Beautiful. Go for
it. Yeah, great. Should I just kick off?
Jump in.
Yeah. So thanks, Josh. So I'll start off with talking about all things. It says mortgage, but probably around the property lending market. So maybe just to give you some introduction about Odin. Whoops. I learnt it half an hour ago. I forgot. So before we kick off, just a full disclaimer that the information that we're presenting tonight is general, not taking your personal circumstances into account. So if you would like to get personal advice, would strongly encourage you to talk to professionals like ourselves here afterwards. So maybe just to give you some color about Odin. So the Odin Mortgage and Tax, so we help Australian expats and overseas investors buying and owning properties in Australia and better managing their mortgages and tax position. So this is our 50th year in the business, and we've been helping clients from 50 different countries and have access to 20 plus lenders in Australia who specialize and understand expat circumstances and also a foreign sort of income structure and taxation structure. That's where we specialize. And we also have access to Asian banks for Asia Pacific clients. And we hit a small milestone recently, so have been able to engage with just over 11,000 expats around the world. And by now we have 1,000 expats helping them through buying or owning a property in Australia with Odin. So in terms of mortgage, so we specialize in two things. So one is helping you buying home, whether that's a future family home that you're looking to buy if you were to have a return, or whether you're building an investment portfolio. Our job is to make sure that you have access to the best available solutions in place so that you have the opportunity to leverage and make sure you don't pay more than what you have to when it comes to managing mortgages. And then secondly, refinance. So when you're owning a property in Australia, the common strategy for Australian, not only expats, but Australian property owners is to leverage so that you get to benefit in various ways, such as tax deduction. And our goal is to make sure that throughout the life cycle of your property journey until you sell or close down the loan, that we make sure that you stay on the best available products, whether that's through refinancing your existing loan or negotiating with your lender on your behalf, and then also help you access equity to support your next investment or other needs. So I'll just quickly touch base on the market, and I won't go in deep because Richie from Milk Chocolate will be talking deeper. But just to give you an idea, so as of for the last 12 months, the Australian real estate value has exceeded $11 trillion, and the property asset now accounts more than 55% of the total household wealth in Australia, which means that the asset class is very sticky and stable, and also over the last during the economic sort of downturn and volatility, that the property market has remained very solid, still delivering single-digit growth, driven by mainly Perth, Adelaide, and Brisbane, while Sydney and Melbourne were going through some corrections. And one of the hot topics of the market this week is interest rates. So in February this year, the Reserve Bank of Australia has dropped their cash rate for the first time in the last 4 years. And yet again, this week, the government has announced another drop. So the cash rate has now dropped to 3.85%. If you look at the chart on the screen, you can see on the left chart towards the right, it's been a very steep upward curve, and we're seeing some stability, which is very good news to the market. And what that means is that the average interest rate for home loan in Australia, particularly investment home loan, is somewhere between 6.09 to up to 6.3%. The recent news this week means that all the lenders started passing the rate up, so that if you hold an existing property with a mortgage, that you should be taking the benefit of the rate up by 0.25%. And also we're seeing more lenders now coming up with stronger product offerings and also flexible credit policies so that they can attract more buyers and borrowers coming along.
I was just going to ask, so these rates, if people are seeing these rates in the news and watching Australian media and following that, these are the rates that they can translate to potentially being available for them as well, even though they're not in Australia?
Yeah, of course. So of course it's subject to credit assessment and going through your personal circumstances. One of the myths that I would love to bust tonight is that many questions that we get asked from our clients in New York or States that because I'm outside Australia, am I penalised in a way that I have to pay premium? No, that's not the case. Australian banks do not treat you differently because you're living overseas, as long as you hold onto Australian passport or permanent residency. If you do not hold Australian residency, that the interest rate and the product offering might be different. That's where we can actually help you make sure that you don't overpay. Any other question? I'll carry on. So I'll just quickly share some tips or just general knowledge around when it comes to buying a property. So when you're looking to buy a property in Australia, your purchase price is driven by two things. One is your deposit, which could be your cash savings or equity from your existing property that you could access to contribute towards the purchase. And the other part of the equation is the loan. And that's driven by your borrowing capacity based on your income, expenses, and assets and liabilities. And we specialize in understanding your current circumstances in the States and also how the US income taxation works. So our job is pretty much translating your circumstances into Australian lenses language so that when you apply for a mortgage for your purchase or refinance, that the experience to get the approval is as seamless as possible. One thing that I'd like to touch base is that when it comes to deposit, so many of our clients underestimate the other costs besides 20% deposit or 10% deposit. So if you're an Australian living outside Australia, you still need to prepare stamp duty, but you're not subject to any foreigner or non-resident surcharges. So typically the stamp duty could be anywhere between 5 to 6% depending on the states and the purchase price range. If you do not hold an Australian passport or Australian residency, that you may be subject to the Foreign Investment Review Board, FIRB, that you need to apply for approval to have grant to make a purchase in Australia. And typically there's an application fee, and then also you may be subject to foreign surcharges. And I'll just finally touch base on the general process. So at Odin, we have created mainly 4-step process to buy your property as well as own it. So it starts from assessment, which is typically preliminary assessment, to understand your circumstances so that we can actually help you understand your borrowing options. So we have created a digital experience where our platform talks to different banks and lenders, policies and calculators. So without a single paperwork, through a conversation, our specialists can help you understand what your borrowing capacity might be, which lenders will be able to support your needs and objectives, so that you have confidence before you actually commit to proceed with a formal approval. And then once you're comfortable with the options, they will help you submit an application, collecting your documents and translating all those information into, again, Aussie Bank's language, and we'll go through the pre-approval. So one thing that I'd like to stress out is many of our clients till recently, for those people who had intent to buy a property in Australia, they're watching the market but not necessarily arranging their pre-approval in place. So with the recent rate cuts, we're seeing more and more applications that are coming to the market. And what that means is that, it creates competition. And because of that, Australian lenders, they're actually dragging their turnaround time. Typically it takes about 2 to 3 weeks for you to have the approval in place. But we're now seeing some lenders actually taking up to 5 weeks to prepare the approval. That means that if you find a property that you like today, if you don't have pre-approval, if the other prospect buyers have pre-approval, they're more likely to win the property. So what we encourage is that for our clients who are looking to buy a property in Australia, if the question is when, not if, then arranging your pre-approval upfront is not going to cost you anything. We don't charge any fee for our mortgage services when you charge banks and lenders, but having the pre-approval in place would actually make sure that your finance doesn't become a blocker or delay to support your property buying journey.
I was just going to ask the translating the documents for banks. If people go directly, because I guess you can, in theory, go straight to a bank and say, I want to apply for a mortgage. What are the mistakes, or what what are you translating? What are you changing it when you're putting together the package for the banks? Just, I think it helps to understand, conceptually what is different.
Yeah, absolutely. So I'll probably just use two examples very quick. One is the tax return. So for those who had their tax return done in Australia and here, and I'm still learning that that it's quite different. The way that the US I should probably talk to him. Yeah, right. So the way that your income is documented in the US taxation office, Australian people or staff or the bank does not have the system and knowledge to actually understand. So it is our job to not only converting USD into AUD, but then also break down each line into Australian language so that you're not penalised by the fact that you're paying tax here. And secondly, the most common mistake that we've observed from expats in the US is credit card. So I noticed that a lot of
We love them.
that's a word that I was going to use. I think US banks love issuing credit cards. Let's put it that way. And I understand and I appreciate it's a different credit scoring system here. So the greater the credit limit that you have access to, I understand it actually makes a positive impact. Whereas in Australia, it's completely opposite. So let's say you had $20,000 credit card limit here, and then with your healthy credit score, you have been offered $100,000 credit limit, which is positive here. But then what the Australian lenders would do is that regardless of your outstanding balance and your repayment records, they would actually take the $100,000 credit limit as an existing liability and reduce your loan amount by that. And just to give you a benchmark or idea, 50,000 USD credit card limit, it's almost equivalent to $550,000 or $600,000 AUD in terms of the loan amount. That's the difference it would make. And we've had so many clients who went to Australian banks and they were so demotivated because their credit card was actually killing the deal. And that's where we can actually come in to help you structure your application in a way that pretty much like convey that positive credit score in the States into make it as a positive impact to the application in Australia.
Just out of interest, hands up, who has more than 2 credit cards in the US? Yeah, so I'm not.
And just to finish off, so once you have the approval in place, we have our dedicated settlement team who work with your conveyancer or solicitor to make sure that your settlement is not delayed. So one of the very sticky experience is that because you're living here, we're here. Unfortunately, Australia still loves paper. So your mortgage document, land title office documents, all of those would have to be posted out from Australia to here, and then you have to sign and post them back. And we've seen quite a few clients making mistakes because the mortgage document in Australia and other legal documents, they're quite foreign, very different here. So we've got a dedicated settlement team who can actually help you, guide you through line by line to make sure that you can actually have a one-stop settlement experience. And as I mentioned, that our experience lasts until throughout your property life cycle. So we have our dedicated concierge team who would help you post-settlements to monitor your loan accounts to make sure that every half a year, every year, if there are other better offers available, that we would make sure that you're informed. And also, we actually do heavy lifting to push your lender hard enough to get the extra discounts as much as possible. And then when the tax season comes in, this is where Pau's team will come in, that make sure that you don't miss out any line items or expenses when you're preparing for your tax return. So that's what Odin Mortgage does, and our goal is to make your home loan application as effortless as possible, so that your home buying journey doesn't become stress. So I'll just quickly touch base that so we're here till Saturday this week. So thankfully we had our calendar filled up until Friday, and we just managed to open up a few more slots available. So a complimentary one-on-one appointments are offered if you'd like to have a chat about whether that's buying a property or your existing property related to mortgage or taxation. So by all means, take a photo and you can book a meeting through this QR code.
There's also this QRs on all the tables as well. So, all right.
Great.
Thank you, Stephen. Round of applause for Stephen. So, Pau Lam, Director of Tax Services for Odin Mortgage Tax. Good little segue at the end, Stephen. It's almost like you guys at practice there. So you are managing tax. So you do everything from the strategic tax to the tax filing. I know we caught up yesterday, and you're a busy man. You've been a busy man for some time. What is it about? Like, for anyone here, why does Odin Tax sort of resonate with people? What are you doing for them? So really briefly, big picture that people like.
Yeah. I think the most important one is you guys are in the state, tax is complicated already. And when it comes to a cross-border tax back in Australia, they just add another layer. And just coming from experience for the last 10 years, I've seen too many expats sitting aboard that they thought they had nothing to do back in Australia because they left already. But it was not the case. And eventually when they realized that, oh shit, sorry for my language, it just happened that you just get hit with a huge amount of tax that all in a sudden you just need to come up with that money. So we are here to make sure like you don't fall into that traps anymore. You understand, if you want to make a decision for investment back in Australia, you know all the in and outs, how does it impact you in the long run. So that's I think the most learnings I've come across for our clients living abroad.
Please go for it.
Cool. So I would try to keep this short. This is surely to like 3 hours of talking, but Josh asked me to put it into like 10 minutes. I have to take 15 minutes. Sorry, Josh. Give me another 5. So again, I'll just quickly go over what we do, help you with the tax return, tax advisory, and tax planning eventually. If you do have a plan to go back to Australia, how does it work? How to translate your overseas savings assets back to Australia without triggering a huge tax issue like in Australia. I'm going to focus on 3 things today: tax residency, the property tax, negative gearing, and eventually when you sell the property, the capital gains, how does it work back in Australia? For the rules, we're still using the rules written 80 years ago back in Australia. Very stylish. The 3 that we mainly look into is 183 days, the reside test, and domicile. The last one is more for people working for the government. Like if you're working for the consulate here for the Australian government, then you will probably fall under the super test, which means, yes, sorry, you are tax resident in Australia, regardless what the other factors may affect you. So I'm gonna just focus on the 3, the 183 days, how long do you spend your time in Australia, which I assume most of the people here actually don't spend that much because you have your life here in the state. Unless you have a plan of, in terms of transiting back to Australia, I think your number would increase. But for most of our clients living abroad, they don't really spend that much. So from a number perspective, it should be okay to stay below the 183 days mark in Australia. The reside test, this is what they look at. Where do you live? You live in the state, do you have a visa? What is your employment? Is everything happening here? They also look into do you have a long-term lease, or do you only be here for temporary, living in an Airbnb in a service apartments that somehow maybe you have a plan to return to Australia eventually. And also look at the families. I've come across quite a lot of cases that an expat came overseas, live in the state, eventually maybe for schooling problem for the kids. The wife and kids have to go back to Australia first, and then maybe the husband stay behind. That also add another complication to the situation, because now you have an alien spouse living overseas, but the kids and the family back in Australia. And that would be even more complex to handle the tax issues in Australia, because you want to make sure you still can be seen as a non-resident. So whatever you make here has nothing to do with Australia. To the domicile, which is the most difficult, most challenging rules that when ATO look into it. Because what they look at is, where do you actually see as your home? Where do you want to see as your permanent place of abroad living overseas? And this doesn't mean that because you're holding an Australian passport, you always have to see Australia as your home. I wish everyone is looking from that perspective, but it can also be from by choice. Where do you choose to be living? If you've been away for minimum, like from our experience, usually 3 years is kind of the gap. If you have been away for 3 years, it's quite safe to say yes, you have been a non-resident, but you're only away for 1, 2 years, which is kind of like temporary. It just add more roadblocks with the tax office. I'm trying to explain where is your home? Where do you see as your permanent place of abode? And the last one, the superannuation, if you're working for the government, again, I mentioned if you do work with the government, you don't really need to look into any other tests. You are default to be a tax resident of Australia, including your spouse as well. And in terms of the properties, this is most of our clients, while they're living abroad, what they still have in Australia, which is the investment properties they still own, which could be their main residence before or the one they invest later on. So it's really just a 3-stage of tax when it comes to investment properties. The cost of buying a property, cost of running the property, and eventually when you sell it, what is the cost to exit? I think Stephen kind of mentioned about the cost of buying, the stamp duty, the FIRB, the foreigner, so I'll probably keep it short. 3 things. One thing that a lot of people kind of miss is this land tax. So this is kind of hidden for some of our clients that eventually they got hit by the state revenue office, 10K please, and that's every year. So you want to understand the rules in different states, and also you're a citizen or you're PR, how does the rule different in terms of buying property? And ideally, you would like to diversify your investments in between different states to minimize your land tax payable. Because stamp duty is one-off. You pay it once, it's gone. But when it comes to land tax, it's annual. Once you trigger a year, you cross above the threshold, you have to pay it every year. And we have seen a lot of clients, they need to pay 30, 40K per year, which your rent is not even, or the growth of the property is not even there to cover the land tax. So eventually they have to sell the property and just exit. Eventually, the capital gains, when you sell, what sort of tax you pay. These are the costs of buying, and literally all of these can be deductible against the capital gains when you sell one day. The stamp duty, the conveyancer, if you use Richie for helping you to buy the property, their fee is also deductible. Any of the miscellaneous and the FIRB if you are like a foreigner. And here will be another strategy is if you're married to a non-Australian spouse, yes, there are ways to help you minimize some of these costs by potentially putting the property under the Australian name to avoid the surcharge. And here is the cost when you settle your property. Likely you're going to rent out your properties and what can be deductible against rental income. We look into the council rates. The rule of thumb is pretty much every dollar you spend on the property is deductible against the rental income, including the council rates, water rates, land tax, insurance, any of the repairs, maintenance, and the biggest one is the interest on the mortgage. If you're buying an apartment, the body cop, and depreciation, etc., and also our fees is also deductible against the rents. In most cases, if you are considering using a mortgage, you're likely because the interest rate is still high, like 5, 6%. When you factor in, this is a quick example here. If you buy a property, you earn a $45,000 in rents. When you factor in the mortgage, all the other expenses on the property, you are likely to make a loss on the property because of the mortgage and everything. In that case, you don't need to pay tax in Australia because you're making a loss on the property. You can accumulate the losses here in, let's say, $15,000 as an example. And that also would help to translate into your US tax as well. If you are making a loss on the property in Australia, that would also be reflected in your US one that you don't need to pay tax in the US for this rental income. Until the point this becomes positively geared, then yes, there might be tax in the US side for you. And these losses can be carried forward indefinite. You don't need to worry about, when do I need to use it? There's no time limit. You can use it eventually when you start to make income. When you move back to Australia, working, earn an employment, or when you pay down the mortgage, the property becomes positively geared. Or when you sell the property, you have a capital gains. All of these future income can be utilized with these losses. And this is another very common questions that we have been asked around, what is the best structure I should consider? Should I buy under my name? Should I use a trust? People talk a lot about trust in Australia. Why I can't use it? So I would like to break this one into like two parts. Tax, of course, but then the other one is the mortgage. If you're thinking using a mortgage, because we already have limited lenders who would consider expats when it comes to foreign incomes, and not all of them would consider a trust structure for expats because that's just another layer of difficulty. So you have to consider the mortgage and tax. But from a tax perspective, people use trust a lot in Australia because you can distribute the income to different beneficiary and pay lower tax. But from our experience, the expat family are all based overseas. So you don't really have anyone in Australia being a beneficiary. You can distribute the income to, and because the property is actually making a loss, there's no income to be distributed anyway. And regardless how you distribute to your kids living overseas, your husband living overseas, you're gonna pay the same tax starting from first dollar at 30% anyway. It kind of loses the meaning on why you want to use a trust to make it more complex, and there's more cost on running the trust structure. So most of our clients would end up buying just under their personal names, so to one, secure the finance, and secondly, to avoid the complex on using a trust, because at the end of the day, you're gonna pay something similar. And finally is the capital gains. What happens when you exit? There are different rules. We talk about like this called a taxable Australian property that include Australian real estate like properties. These are taxable regardless you live in Australia or living overseas as an expat, as a non-resident for tax purpose. There's another class which you call non-taxable Australian property. This is like foreign investments you have overseas in the state. It got nothing to do with Australia for now, so you don't need to worry about tax on those. And also shares you buy in Australia or buy overseas. Rules are quite special that you don't pay any capital gains on Australian shares. You buy as a non-resident. So yes, we do have come across with people, especially with skill set in the equity market. They would rather look into the equity market because they pay nothing at the end of the day when they exit. Just quickly on the properties again. There's another difference as well for residents, people in Australia. For an investment property, they can get a 50% capital gains discount. But for us, because the rule changed in 2012, so we no longer enjoy the discount. So that's obviously a disadvantage for expats to buy a property. But I guess the good side is, yes, negative gearing still applies. And the tax rate is the same as at 45% in the top bracket compared to people in Australia. And there's also another rule change in main residence. If you do have your property that you used to live back in Australia, you want to be mindful not to sell it while you're living overseas, because if you do, you will lose exemption. You're going to treat that property as an investment property from day one. Whatever profit you make become taxable. So if you do have a property, main residence especially, I would like to have a chat with you to make sure that you understand what are the rules and how to avoid paying thousands of tax to the tax office, because the difference could be more than 50% tax that you pay. And lastly is this 15% capital gains withholding. When you sell, it's more difficult now these days when you try to sell property in Australia, because the government know that you're living overseas, and just based on the history experience they have, people back then in the days, they just sell the property and disappear, ghosted. And there's no way for the government to try to find them because you're living abroad. So now they become smarter. They come up with the idea, say, hey, when you sell the property, let me take a cut from your proceed and to be treated as your potential capital gains. And you can talk to me to see whether you can get a refund or not. So there's now the 15%. Back then, they're talking about, hey, when you sell a 2 million property, yes, I will use the rule against you. But now they changed the rule to even you're selling for $1. They still want to take the 15% cut from your sales of the property. Just a quick example here, if you buy a property for investment, living abroad as a non-resident. Here, we just say you buy a 700K property in 2017, you sell it for $1 million now. What sort of capital gains do you make? What sort of tax you need to pay? So simply the sales price minus the cost, the purchase, and the cost of buying the property, the legal fee, stamp duty, agent fee, etc., all deductible. You would have made a capital gains of 210, and because of the losses that we mentioned before, you probably would have accumulated 100k losses because of the expenses that you pay. That will help you to bring down your net taxable income to 110k, and you only pay tax on that numbers. There's another strategy we can use is Australian super. So most of our clients, being an expat, they are kind of behind than the people in Australia on their super. So that is another good vehicle you can potentially use some of the proceeds from the sales of property to inject into your super and claim as a deduction to help you minimize half of the tax as well. So there are ways that even though we kind of lose the 50% discount, but yes, there's the other ways we can try to make it up to save some sort of tax. So just a quick takeaway, yes, consider leveraging because of the negative gearing, because of the power of leverage. You might want to consider having a mortgage if this is purely for investment purpose. If this is for main residence, then I recommend the opposite, not to have mortgage because you can't claim anything anyway. And take advantage of the negative gearing to diversify your investment as well. The example I gave before, land tax, kind of hidden. Don't put all your eggs in one bucket in one single state. Try to diversify, and we have experienced clients back in Victoria, Melbourne, rule change all over the night. They need to pay 5 digits of land tax. So from that aspect, you might want to consider just diversify your investments if you do want to create a portfolio in Australia. And again, Australia is good in the way it's more stable compared to most markets in the world. You don't expect a 30% increase overnight over a year, but at the same time, you won't expect a 20% drop throughout the year. So if you want to go into the market, I'd say this is more likely to be a long-term investments that you might want to hold for a minimum 5 to 10 years, where the property can increase in value, where you make your profit from, because from a rental perspective, having the mortgage, you're not really making anything from the rents. Okay. Right.
Just to ask, if people are sitting here saying, like, this all sounds great, and one of the questions we always get is the fact that the tax year is different in Australia to the US. When should people be planning, like, are there particular times of year that they should be starting to get the wheels rolling? Is it years in advance? Like, some people might be thinking, like, I want to move in the next 6, 12 months or 12 to 24 months. Is there an ideal timeline for people?
Yep. From a tax perspective, there's no distinct time that you should return during a period of time in the year, because it's quite simple in Australia that we look at the date when you arrive if you do have a plan of going back. The date when you arrive would make you a tax resident of Australia. We only look at after these dates. The difference now and later is like when you go back to Australia, you're going to be exposed back to the worldwide income. So whatever you make in the state, whatever you have in the state, now become taxable in Australia. So you just want to make sure, like, when after the day when you go back, there is no more foreign income that you have. Or if you do wanted to keep your investments in the state, just be mindful that the rule is going to be different. But luckily, there's a DTA double tax agreement between the US and Australia. So if you're paying tax here, that can be used as a credit back in Australia, so you're not penalized twice on the same amount of income.
Yeah.
Cool. So then I'll pass back to Richie to talk about the property market.
Sure. Thank you.
Yeah, it's a good segue. Thank you very much, Pau Lam. So Richie Regal, just like Bagel, is how he told me to remember. Richie, you are the co-founder of Milk Chocolate.
That's great.
So you've done a bit of everything. You know property, but you also know sort of the product and the data that goes into it. Was Milk Chocolate born out of a frustration for you, or was it born out of an opportunity? Like, how did we end up sitting here tonight?
It's a good question. So myself and my business partner, Michael, who's sitting over there in the blue jacket, we both were living overseas as Australian expats at different points in time, and were trying to purchase properties back home in Australia and found it really difficult to execute. It still is archaic in terms of the process. It's fragmented. You've got to talk to multiple stakeholders throughout that particular journey. And we just found it really, really difficult and ultimately couldn't end up purchasing properties. So this admittedly was about 10 to 15 years ago. Times have changed, but we decided at that point in time that we really wanted to create a business that helped Australian expats get onto the Australian property market. So in 2017, we commercialised the business Milk Chocolate, and since 2017, we've been helping Australian expats to purchase property back home in Australia. So we've been working with expats in Singapore, Hong Kong, and the UAE, and more recently in the US and the UK as well. So to answer your question, yes, it came out of a pain point that we experienced personally, and we started a business basically to help solve that problem. And we always had the intention to digitise the process as much as possible. So yes, the business has subject matter experts, which I can talk to shortly, but we also wanted to digitise that process and make it a lot easier for Australians living abroad to purchase property back home, but for anyone looking to get onto the property ladder as well.
I just laugh because I think, Stephen, you were saying that everything in Australia is still paper, but living here I still write checks. So anything digital is magical. So go for it.
Cool, thank you. So, like Pau, I got given 10 minutes as my my time limit, so I will try to work through this as quickly as possible. So what I wanted to talk about today was just quickly about what Milk Chocolate do. So I'll touch on that shortly. The current state of the Aussie property market, the national property clock. So just getting an understanding about where capital cities in Australia are currently sitting in terms of the property cycle, what a property cycle actually means, and then where the next investment opportunities are. So there's a lot to cram in 10 minutes, and I'm acutely aware that the Knicks are also playing at 8 o'clock. So I don't want to be that person that stands in between, so I'll race on through it as best as I can. So as we touched on, so at Milk Chocolate, we help you plan, buy, build and manage property. As I mentioned, it came out of a pain point that we experienced personally. And essentially, we created a business that allows buyers, whether that's an investor or an owner-occupier, to with a streamlined process to get onto the property ladder. So we have a team that consists of strategic and game plans, research and data, buyers agents, building and project management services, and property management services. So essentially, as you can see, we're trying to own that whole ecosystem and help you get onto the property ladder and remain on the property ladder. Obviously, you'll be dealing with Odin from a mortgage and tax perspective, but everything else thereafter, we built the business to help you execute across that whole journey and make it as easy as possible. We have built our own proprietary platform called the Milk Bar. That is driven by data and subject matter experts, which essentially just makes that whole process a lot more seamless, which I touched on. We're nationally licensed to purchase properties in Australia, excluding the Northern Territory and Tasmania. That's just because of the nature of our investment thesis and where we like to be purchasing properties. And at this current stage, those two markets aren't sort of on our list at this particular point in time. So that's essentially what Milk Chocolate does. As I touched on, we have assembled a world-class team, subject matter experts across those verticals. So we have economists with PhDs, we have property economists, qualified property investment advisors, we have licensed real estate agents who are ex-sales agents. So they now work as the buyer's agents. So we see them as better buyer's agents because they know the selling process, they know how a deal is put together, they know how to negotiate on property, and they're supported by due diligence specialists as well. From a design, build and project management perspective, we help you, whether that's a renovation of a cosmetic nature, all the way through to subdivisions, townhouse subdivisions, etc. So we have a construction project manager in-house who's got a PhD in construction project management, a licensed builder who's currently based in Brisbane, and also an in-house architect as well. Sure. And then from the property and portfolio management perspective, that sounds better. From a property and portfolio management perspective, we have in-house property managers, leasing managers, and maintenance managers. So again, just to touch on that previous point in terms of owning that whole ecosystem, we have the team in-house supported by technology and data to make that process a lot more seamless. A little bit about me. So I've been purchasing, renovating, and selling property since 2006. So my role in the business is that I oversee the data and analytics, the purchasing and construction teams. I've personally assisted hundreds of our clients build property portfolios through the game plans that we prepare for them. I've overseen $400 million worth of property transactions in Australia, and I've personally purchased about 120 properties for our clients as well. So my role in the business is quite unique in the fact that I get to work with our clients from a strategic perspective, but also oversee that purchase and the ongoing construction if that is relevant to that particular game plan. But enough about myself and milk chocolate. Let's take a bit of a deeper dive into what's currently happening in Australia from a market perspective. So just firstly, the highlights. So price momentum at the end of 2024 was starting to cool, but certainly on the back of that first rate decline in February this year, we certainly saw buyer confidence boosted on the back of that first rate cut, and we've seen a lot more buyers coming into the market, which is putting a lot more pressure on demand in most of those major capital cities, in particular in Sydney and Melbourne, which I'll get to shortly. But given the nature of the medium house prices in those particular markets, where the mortgage and the debt is generally higher, interest rates have a greater effect whether they're going up or down in those particular markets, more so than some of the other capital cities in Australia as well. So prices were slowing at the end of 2024, but we've certainly seen them accelerate into 2025. Tariffs, which I'm sure you're all well aware of, it's certainly denting household confidence in Australia and expats abroad as well. And I'm not here to tell you what's right or wrong, but so what we are seeing and what we have seen historically is when there is a little bit of instability from an equities market perspective, investors tend to put their investments into bricks and mortar and those safer investment classes such as cash and gold, for instance. We're certainly getting a lot of buyer inquiry suggesting the same thing, so looking to move their money into the Australian real estate market, which has generally been seen as a really safe, stable investment asset for a long period of time. So that's having an impact. Transactions are certainly starting to increase now. We do know that obviously Labor is in government for another 3 years. One of their key policies was to help first homeowners get onto the property market. That policy was a 5% discount for first homeowners, and the government would subsidise the remaining amount. That's obviously quite significant because it is quite difficult for first homeowners at the moment to get onto the Australian property market. So that's certainly going to put more pressure across most markets in Australia and drive more demand, which generally means price appreciation across those major markets as well. The guys have spoken about rate cuts, so there has been 2 rate cuts so far in 2025. We certainly had evidence of that buyer confidence on the back of the first one. The other one just happened yesterday, so I don't have any hot off the press information just yet, but it's likely going to continue to drive buyers. It's going to create more credit in the market. We personally believe that there's likely going to be another 1, potentially 2 more rate cuts in 2025. So the guys will probably have more intel on that than we do, but that's what we're seeing and that's what we think. And that's ultimately going to continue to drive buyers into the market. And then finally, rental growth. So we've come off record highs. So on the back of COVID, we saw rents increasing 10% year on year, which is extraordinarily high. Historically, they sit generally between 2 to 3%, and they're currently sitting at 4.5%. So it's good and bad. So it is difficult for tenants because the prices are increasing significantly across all major markets in Australia. However, those rate cuts are certainly going to ease a bit of pressure from a landlord's perspective and reduce the need to put up rents as much as they have been. So I suppose that's just some of the highlights that we're seeing in the Australian property market at the moment. A little bit of a quick around the ground, so I'm not going to go through every single line item here, but what we've got on screen is basically the Australian capital cities on the left-hand side, the medium house price currently, the percentage change year on year, percentage change quarter on quarter, and the percentage change from the previous month. The reason why we've got those 3 items on there is really just to take a bit of a broader look at what's happening over the longer term, so i.e. 12 months versus what we're starting to see in more recent times in the last quarter, and then evidently what's happened last month as well. So there's a little bit of a story that we can tell here. In some instances, you can see that year-on-year change is sitting in a negative value, so Canberra, Melbourne and Darwin. Interestingly, with Melbourne, so the last quarter we saw a positive growth in that particular market, so that was the first positive change quarter on quarter since COVID. So 0.3% is certainly a great thing to see, and another 0.1% in April as well. Melbourne, as we know, had extended lockdowns, so about 13 lockdowns post-COVID, which literally ripped the handbrake up in that particular property market for a significant amount of time. We saw a lot of people leaving that particular state and moving to New South Wales and southeast Queensland. But it is great to see this market starting to turn again as buyers are starting to see more value in this particular market in comparison to some of the other major capital cities. It's, I suppose, contrary to what we're seeing in Brisbane, but this may be just a bit of a glitch in the system. So 8.7%. So Brisbane, Adelaide and Perth have been the strongest performers over the last 2 to 3 years. Brisbane did see a negative quarter-on-quarter change of 0.3%. However, last month we saw that change to 0.4%. So I think certainly impacting that was the recent rate cut in February, and also by seeing a little bit more confidence in the market. It is still within the current property cycle, still appreciating. We still think there is going to be a good 12 to 18 months of positive growth in that particular market, and that is driven by the major infrastructure projects in Brisbane through the Olympics as well. So it's still relatively affordable, and Brisbane is now quite a large market, so it's important to segment that particular market because there is affordable markets that are still within a commutable distance to a major CBD connected by public transport, and they're still performing well, and they'll continue to perform well as we sort of move forward into the next 12 to 18 months. The other one I'll just point out there is Darwin. So it is the most affordable capital city at the moment. Negative 4.35% over the last 12 months, but as you can see, significant change in the last quarter with a positive 2.4% growth. That's primarily driven by affordability and the significantly higher yields across houses and units in that particular market. And we're also seeing a bit of social media spruiking from some property spruikers pushing that particular marketplace as well. So it's a market that we're not too fond of because it is reliant on generally 1 to 2 economic drivers, which is something that we don't prefer. We look at other macro influencing factors that are going to perform over the longer period of time, not just that short immediate growth. So we certainly do expect that market to perform really well in the next 12 to 18 months based on its affordability and its yields. However, we don't believe that's probably a wise investment as a long-term play. So I suppose that is a quick wrap around the grounds. We can also share these slides with you because I appreciate there's a fair bit of information and numbers on that screen. So we can share that with the guys afterwards as well. Now just taking a look at the national property clock. So 12 o'clock being the peak of the market and 6 o'clock being the bottom of the market.
I feel like this is a play school for grown-ups. Through the round window.
Sorry, it feels like I'm talking down to you. I'm not. And so we've obviously highlighted, I suppose you call it 6, 7, 8 o'clock, the bottom of the market and the start of the recovery, those cities and regions in Australia that we believe are sitting in that particular period of the cycle. So the reason that's highlighted in green is because it's likely going to be the best market to be purchasing in right now because it's going to give you the longest sustained amount of growth in the short to medium term. So if you're looking to build an investment portfolio, you want to be maximising your equity growth initially so you can continue to generate equity, use that to continue to purchase additional properties. If you look at that contrary to some of those locations at the peak of the market, they're likely going to see a dip over the next 12 to 18 to 24 months and likely you'll be in a negative equity position. So it is really important to understand the market cycles and which particular markets are sitting at which particular part of the journey in their cycle. In the next slide, we'll talk about that in a little bit more detail. So as you can see, the start of the recovery, we've got Melbourne, Hobart, and then you've got basically the rest of regional Victoria, including Geelong and Ballarat, and Central Coast, Newcastle and Darwin, and then the bottom of the market, Byron Bay, Illawarra and the Southern Highlands. We do believe that Canberra is about to move into the bottom of the market as well and start its next price appreciation cycle. So that's not too far off. And then when you look at the other side, you've got Sydney and Brisbane in particular approaching the peak of the market. However, as I touched on previously, they're both significantly sized markets and there is segments within those markets that are going to continue to perform well over the short and medium term. For Sydney, for instance, you've got Greater Western Sydney where there's a significant amount of infrastructure being spent there. So it's creating about 200,000 jobs, which is going to continue to drive employment in that particular market. and that's going to be certainly sustainable in comparison to some of those other blue chip suburbs and regions within Sydney. So that's a little bit about the property clock and where some of those capital cities are sitting at the moment. This particular slide is a good segue from the previous slide because it talks to when you look at the historical average time spent for each capital city in either the peak to trough cycle or the trough to peak cycle. So certainly this is not historical performance is not an indicator of future performance because there is always certain elements overlaid on top of what's happening right now that may influence different markets differently. So Melbourne, for instance, you can see the average cycle trough to peak, which it's just moved into. On average, it's only been that period for about 4 quarters, so 12 months. However, given the delayed lockdowns and the sort of the significant handbrake that was pulled up in that particular market over a period of time, we can certainly guarantee it's going to sit in the price appreciation cycle a lot longer than 3 more quarters. You can also look at Canberra, for instance. So historically, we've seen it since at 8 quarters in both cycles. It's currently just had its 8th quarter of negative growth, and as we just touched on, April recorded its 0.1% growth. So therefore, it's likely going to be sitting at the bottom of the market for probably a couple more months, and then we're moving to the next phase of its growth. So it's a great chart to look at. It sort of just goes to the previous point around understanding the market, understanding the cycles. And yes, it also talks to the point that there is always an opportunity in Australia to be purchasing property because there's always going to be a market at the bottom of the market or the start of the next cycle. And so it's just making sure that you don't wash what you're seeing on mainstream media when the SMH blasts out the Australian property cycle is about to boom or it's busting, because they're throwing all of those markets into one statement. So it's not correct. It's important to understand the information and the data and make wise decisions. So where and what should I buy? I'm not necessarily going to tell you that, but I can tell you what to expect. So what we do know from a major capital city perspective is that Perth and Adelaide are likely still going to be the top performers in 2025 and 2026. However, Melbourne and some of those regional markets are certainly going to see some strong rebound and accelerated growth in the short and medium term. Apartments may outperform houses for another 12 to 18 months, and that is primarily driven by affordability, the stronger yields. However, if we do continue to see interest rates being cut, that may see investors wanting to move back into houses which historically have performed better than units from a capital growth perspective over the longer term. Regional WA, SA and Queensland have been performing well recently, and they'll likely continue to do so for 2025. And expect to see Darwin record growth driven by lower entry prices and those higher yields as well. And then outside of that, other things to look at when you're looking at areas to be purchasing is investment in infrastructure. So as I touched on, Western Sydney, there's significant amounts of infrastructure being built in and around the new airport, the rail links and the road links in and around that area. Southeast Queensland due to the Brisbane Olympics. And then you've got other markets as well, such as the Melbourne Airport. You've got healthcare, so Monash and Frankston in Victoria, and also some suburbs in northern Adelaide. And then finally, the metro in Perth is going to continue to promote growth in that particular market. So that's what you should essentially be looking out for. There's obviously multiple factors that we look at as well when we're assessing different cycles of different property markets, and our team are continuing to look at what is the next location hotspot at different price points and different yield requirements, but these are some of the things that we're taking into consideration as well. And then just finally, so buying with confidence. So as I touched on at the start, essentially we've developed a platform that is powered by those subject matter experts to make it really easy to execute what I've just spoken about. So the platform allows you to identify what you're looking to do. It will build out a game plan strategy for you, so that will help you determine what is the best path forward. So if you understand what is your borrowing capacity, what's your goals, is it in 10 to 15 years to retire on a passive income that would supplement your monthly salary, for instance, we can show you how you can use properties and the strategies within properties to help you execute that particular goal. We'll then pair the right location suited to the output of that game plan. So we're certainly not a one-size-fits-all approach. We have identified locations all around Australia, and so ideally we want to be pairing the right location that's suited to the outputs of that particular game plan. And then you can track the whole search and purchase journey through the platform. And then obviously the continuing ownership period as well, where you can track your portfolio performance in real time. So I think that was 10 minutes, right?
Absolutely no.
Yeah. But that's essentially us, guys. That's Milk Chocolate. Hopefully that gives you a little bit of information about what we do. If you like, you can scan the QR code. Michael and myself will be around tonight, and we're here until Saturday as well. So we're more than happy to catch up with you guys for coffee and learn a little bit more about what you're looking to try and achieve, and we can take you through our services in a bit more detail. But thanks for your time.
Richie Regal. Thank you, Matt. We're going to pick all this. The most important thing I took from that was that Adelaide is winning.
Adelaide is winning at the moment.
Yes, 18 months of positive growth. I'm going to remember that. So we've heard obviously a lot of things, and I know that a lot of you are going to have questions. If you do have a question that you'd like to ask now, if it's sort of broadly applicable and you think other people might be interested, shoot your hand up. While you're thinking about that, I have one question, Stephen, just around if somebody's sitting here and saying like, this all sounds great, is there a particular order to which you guys get approached? Is it all at once? Does someone just say like, yes, I'm interested in buying a place and I need to speak to you all simultaneously? I'll start with you just really quickly.
Yeah, it's a great question. I'm biased. Given I'm the finance person, I think knowing your numbers is probably the most important exercise before you start planning or even trying to execute. So whether that's understanding your tax position or working through your budget and location, by all means, know your numbers. So like understand the inputs, how much you could afford to contribute towards a purchase, and then also one thing that a lot of people underestimate is the out of pocket. So while you're buying a property is very exciting, and talk to experts here to make sure that owning a property is also exciting. That if you end up having too much out of pocket that you cannot hold onto the property, that's not the outcome that you'll be seeing. So by all means, talk to me first.
No, I love it. Stephen Lee, Pau Lam and Richie Regal, I want to thank these guys one more time.